Friends, and welcome back. Today, we are deep diving into a real Chupa Rustam of the Indian pharma space, Caplin Point Laboratories. While everyone was busy chasing the big blue chips, this company has been silently delivering a staggering 10-year CAGR. Basically, we are looking at a business that didn't follow the herd to the US market first. Instead, they captured the frontier markets like Latin America and Africa. If you see their journey, it is a masterclass in finding a niche and dominating it. In this analysis, we will see if this multibagger still has more dumb left or if the valuations are getting too stretched for comfort. Let us get started with the fundamentals, shall we?
Now, why is Caplin Point so different from your Sun Pharma or Dr. Reddy's? Only because of their unique business model. Instead of fighting it out in the hyper-competitive US markets initially, they built a rock-solid supply chain in Latin America, specifically in countries like Guatemala, El Salvador, and Nicaragua. They handle everything from end to end, manufacturing in India, shipping, and even local distribution. This asset-light approach, in a way, combined with deep distribution, gives them a massive moat. They are essentially the big fish in a small pond. They deal in cash and carry models mostly, which keeps their working capital cycle quite sorted. No tension of bad debts here, boss.
Coming to the numbers, and oh boy, they are quite impressive. If you look at the top line, the revenue has been growing steadily at around 15–20% year on year. But the real pace of Asul part is their EBITDA margin, consistently hovering around the 30% mark. That is high-quality growth, no? Their return on equity, ROE, and return on capital employed, ROC, are both north of 25%, which is excellent for a pharma player. Plus, the company is virtually debt-free and sitting on a huge pile of cash, around 800 to 1,000 crores. In Indian markets, we love companies with skin in the game, and the promoters here hold a solid 60% plus stake. So, what is the next big trigger for the stock? It is Caplin Steriles. This is their dedicated subsidiary for the US and regulated markets. They have pivoted from just being a LATAM player to filing ANDAs for injectables and ophthalmics. They already have 20+ ANDAs approved. The US market is a tough nut to crack due to US FDA inspections, but Caplin has been maintaining a clean track record. The beauty is that the cash flow from their LATAM business is funding this US expansion. It is like using your fixed deposit interest to buy a new house. If they scale this up, the margins could see another level of expansion in the coming years.
Actually speaking, their manufacturing setup is quite world-class. They have facilities in Puducherry and Chennai that are approved by global regulators. Unlike many others who outsource, Caplin is becoming more integrated. Their R&D spend is also increasing because they want to move from simple generics to complex products. We are talking about liquid injectables, lyophilized vials, and pre-filled syringes. This shift towards complex pharma is where the big margins lie. They are spending nearly 5% of their revenue on R&D now. This is a clear signal that the management is not sitting idle. They are prepping for the next decade of growth.
But wait, it is not all Shubh Mangal here. There are risks you must consider. Firstly, geographic concentration. A huge chunk of their revenue comes from Latin America. Any political instability or massive currency devaluation in countries like Brazil or Mexico can hurt their bottom line. Secondly, the pharma sector is always under the US FDA's kitki. One bad inspection and the stock can tank 20% in a day. Also, as they enter the US, they will face bigger players with deeper pockets. The competition will be Kante-Ki-Tucker. You must keep an eye on these regulatory and currency headwinds before jumping in. Now, the million-dollar question, is the price right? Currently, Caplin Point is trading at a PE ratio of around 28x. If you compare it to sector leaders like Cipla or Sun, it might look cheaper, but remember, those are much larger companies. However, for a company growing at 20% with 30% margins, a 28x PE is quite reasonable in the current Indian bull market. It is definitely not Sasta anymore, but it is not Osman Fad expensive either. Investors should look for buy-on-dicks opportunities. If the US business starts contributing significantly to the PAT, we could see a massive re-rating of the stock. To wrap it up, Caplin Point is a solid, high-quality business with a very unique DNA. They have conquered the emerging markets and are now knocking on the doors of the developed ones. With a clean balance sheet, high promoter holding, and consistent margins, it ticks most boxes for a long-term investor. But remember, pharma is a game of patience and regulatory luck. Do your own due diligence or consult your financial advisor before putting your hard-earned kamai into it. What do you think? Is Caplin Point the next big multi-bagger or just a mid-cap wonder? Let us know in the comments below. Don't forget to like and subscribe for more solid analysis. Jai Hind.